All right, today we're going to break down China's economic blueprint for 2026. And look, this isn't just another report. It's pretty much a roadmap for the world's second largest economy. So let's pop the hood and see what's powering their new growth engine. Everything really comes down to this one number, 5%. That's the big, ambitious GDP growth target China has set for 2026. But here's the thing, hitting that number is a whole lot trickier than it used to be. The old playbook that fueled their incredible rise, it's starting to run out of road.
For decades, China's economy was pulled forward by what economists love to call the three-horse carriage. It's a really great metaphor for the three main things that made it all work. One, massive investment in things like buildings and bridges. Two, consumer spending. And three, of course, that absolute powerhouse of net exports. For a long, long time, these three horses pulled together perfectly.
But one of those horses, that powerful export engine, is really starting to stumble. If you just look at the chart here, you can see it plain as day. The contribution from exports, that's those bars you see, has gotten super erratic. With all the global headwinds and trade issues, this once super reliable horse is now a major source of volatility. So that brings us to the central, multi-trillion-dollar question for policymakers in Beijing, and frankly, for business leaders all over the world. If the old engine is losing steam, what's going to power growth now? Where is that new momentum going to come from? Well, the answer, according to this report, is a huge strategic pivot inward. The new game plan is to focus on China's own enormous internal market to try and unleash the incredible power of its own domestic demand. And let's be clear, this isn't just some small tweak. We're talking about re-engineering the entire growth model from the ground up. The idea is to shift from an engine that depends on and gets rocked by the ups and downs of global markets to one that's much more self-sustaining, powered by its own people and its own companies. Now, the logic behind this big shift gets really clear when we look at the data. On the left, you see all the rising risks from outside the country. But the real story, the exciting part, is on the right. Just look at how China's domestic consumption, as a piece of its GDP, is still way below most developed countries. That huge gap, well, that's pure, untapped potential. So, you can think of this new domestic engine as having two key cylinders that have to fire perfectly. The first one is all about consumer spending. But as we're about to see, just getting it started is facing some pretty big challenges. The single biggest hurdle right now is weak consumer confidence. And the data here really connects the dots to a serious, stubborn problem: high youth unemployment. I mean, it makes sense, right? When young people can't find work, that feeling of uncertainty just ripples through the whole family, and people clamp their wallets shut. And the report is incredibly blunt about this. It's not complicated. People who are worried about their job, their income, and what the future holds, they just won't spend money on anything but the absolute basics. If you want them to start spending again, you have to fix those fundamental issues first. So, how do you do that? Well, the report lays out a very clear three-step tutorial for what needs to be done. Step 1, stabilize the shaky property market, because that's where a massive chunk of people's wealth is tied up. Step 2, help families repair their finances. And Step 3, a laser focus on creating more jobs, especially for young people. Okay, that was the first cylinder. Now let's get to the second part of our domestic engine business investment. And this one is caught in a totally different but just as tricky economic jam. The big problem here is a scary little word, deflation, which just means falling prices. Now take a look at this chart of the GDP price deflator. This is a super broad measure of prices across the whole economy, and it's been negative for nearly a full year. For an economy that needs to grow, that is a massive flashing red light. So why is deflation so dangerous? I mean, hey, cheaper stuff sounds great, doesn't it? Well, not so fast. It actually creates this vicious cycle. Businesses see their profits getting squeezed, so they stop investing. At the same time, consumers see prices falling and think, hey, I'll just wait to buy that, it might get even cheaper. And that spiral can just paralyze an entire economy. And that's exactly what happens when businesses think prices and profits are just going to keep dropping. They pull back. They stop investing in new factories, new tech, new equipment, and that leads to this huge slowdown in what we call fixed asset investment, which is absolutely critical for growing in the future. So to break out of this deflationary trap, the report basically recommends a really strong dose of medicine. It's a three-pronged attack to get money flowing again. It involves the government spending more, the central bank cutting interest rates to make borrowing cheap, and funneling investment into the high-tech sectors that are the future.
Okay, so we've looked at the diagnosis and we've looked at the prescription. But what does all of this actually mean for you? If you're an investor, a business leader, how should this whole blueprint change your strategy?
Here are 4 really crucial takeaways. First, the big opportunities are going to be with the domestic consumer. Second, policy signals are everything. You have to watch government moves on property and jobs like a hawk. Third, don't expect to raise your prices easily. Be ready for that deflationary pressure. And finally, you gotta align with the national priorities. Tech, green energy, that's where the government support, the policy tailwinds are gonna be.
So the plan is ambitious, and the stakes couldn't be higher. The blueprint is all laid out on the table, but the ultimate question really comes down to execution. Can China get this new domestic twin engine roaring loud enough and fast enough to hit that 5% target by 2026? That is the story we'll all be watching.